the three most important indicators are price, price, and price.
I feel like people are equally vocal about how obviously strong economic conditions are and things are great. And then others saying it's so obviously a bubble and things are disastrous.
All of these things did actually, especially factor rotation, did actually correlate with economic data.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today we're speaking with Clint Sorenson. Clint's a fellow CMT. He's the co-founder of Ascentis Asset Management. I've known Clint for a number of years, but we hadn't spoken for a while until the CMT midwinter retreat last month in Tampa, Florida. I was on I moderated a panel that Clint sat on and really enjoyed his perspective. He kindly accepted my invitation to come on the podcast today. So prepare for a great conversation on basically the ways that technical analysis can help you understand the market environment, the ways that technical analysis can help you appreciate risk management and risk appetite, and the way that technical analysis, for those of you that are advisors, can help you communicate with and enrich relationships with your clients. So please enjoy this interview with Clint Sorenson of Ascentis Asset Management. Super excited to be sitting down today with Clint Sorenson. Clint's a co-founder of Ascentis Asset Management. Clint, I've known you for a number of years, but we just recently reconnected at the CMT event in Tampa, and it was awesome to see you. You did a fantastic job on the panel, and thanks for coming on the show today.
Yeah, man, it was a pleasure seeing you then, and I'm so grateful to be on the panel with you today.
I feel like in the post-COVID era, I feel like the benefits of getting back together, it's like when we do it again, I realize how meaningful that is to kind of get the group together and sort of talk markets and talk charts and all those great things. So with our time together today, I know a number of our viewers are obviously individual investors. We have a lot of financial advisors that follow our work as well, and that is really your background, right? In terms of helping others sort of navigate the financial landscape. So I'd love to sort of tease out some of the ways that you use technical analysis and other methodologies to try to make sense of that. If we could at a high level, right? I mean, how do you approach sort of a volatile and arguably sort of transitioning market environment? And how do you sort of use technical analysis in what you're doing to track those changes? What are some of the tools and techniques that stand out to you as most valuable here?
Yeah, no, great question. I believe technical analysis is, as you do as well, is the study of price. And I think price is the most important. I forget who said it, but the three most important indicators are price, price, and price. But I believe that. I think price just gives us such a breadth of information in terms of what's happening in markets, what's even happening in the economy. So price doesn't necessarily mean the price of a stock or an ETF or anything like that. It's also, I use it in indicators as well. So the way I kind of approach things from a technical analysis perspective is everything goes through a technical lens, a study of the data. I have a framework that I call the GRIP framework. So we look at economic growth, where I study trends in economic growth data. We look at risk appetite, which would be your more traditional technical analysis, where we, look at price. We look at relative relationships or intermarket relationships. Some people call them cross-market correlations. It's all fancy for saying we're looking at relative price charts, essentially relative data sets. We look at inflation the same way. So I look at inflation where we actually look at, since ETFs kind of burst on the scene, that's been great too, because we have a lot that we can pull from that correlate with economic data that are present in the market. So we could look at, different inflation sensitive assets, for instance, and get a different measure of inflation expectations. So we look at actual inflation data on the economic front, and then we look at price data of ETFs and relative relationships to try to help us understand what's the market telling us about inflation. And then lastly, we look at policy the same way. So we look at, Fed funds rates, we look at, treasury yields, yield curves, and that tells us everything we need to know about policy. So our entire framework, in terms of how we navigate markets, how we help our advisors communicate with their clients about what's going on in markets, is technical analysis. Just our kind of, way of applying it.
So this is fantastic, this GRIP framework, right? So growth, economic growth, R for risk appetite, I for inflation, P for policy. I love that way of thinking about, arguably the four most important things investors should sort of get their head around. If we could, I mean, let's think about each of these. I mean, when you're thinking about growth conditions, it fascinates me that in this particular market environment, I feel like people are equally vocal about how obviously strong economic conditions are and things are great. And then others saying it's so obviously a bubble and things are disastrous. What sort of, and just the juxtaposition is very striking right about now. What is your toolkit telling you about conditions right now? Are there more reasons to be optimistic or pessimistic? And what gives you the confidence on either side here?
Yeah, and I think it's fascinating that there's such polar opposite, and it's really across markets too. You see the same thing. You see these bull bear. We're never really in one camp. Our job and I'll talk about growth, is really to understand: are we accelerating under the hood? We look at leading economic indicators primarily, or are we decelerating? And then we look at coincident indicators too. And that we've been in this dichotomy for a while, where leading indicators have been declining since April of 2022, meaning they've been a negative trend. So if you look at Conference Board Leading Economic Index, we've got our own kind of leading indicator set as well, but it's very similar. Conference Board does a great job. So we leverage them. We're subscribers to their research. When we look at that leading indicator set, we just look at the trend of that. And that's been in a downward trend. And it's funny, you hear this K-shaped economy all the time. And a lot of people show the chart of the market and the chart of Conference Board leading indicators. And they're like, look at the K, why aren't they agreeing anymore? And they don't have to agree. All that tells us is that leading indicators are declining. So we will simply, from a commentary perspective, say, hey, these leading indicators, the 10 subsets, they're declining with the exception of equity prices, which was the only leading indicator that was actually accelerating in the data set for quite some time. So we talk about them from that perspective. We're saying, hey, this is declining, this is increasing, and that's all we're here to do is measure and map acceleration or deceleration and report on that. I feel like a lot of strategists, myself included in the past, you get swept into the narrative. You get swept into wanting to be right. You get swept into, wanting to take a stance because it's really, it's just ego, right? At the end of the day, it's ego. It's egoic. It's driven by that. You want to be popular. You want to make a call. You want to be right on that call. And ultimately, that's not our job. Our job is to help clients navigate a very complex, multifaceted environment, multidimensional environment, and make decisions with their money and probabilistic decisions, right? And our job is to try to stack the probabilities in their favor. So from a growth perspective, we look at primarily leading indexes in terms of understanding, are we accelerating or decelerating? And then coincident indicators, which are really lagging indicators, we'll study those trends as well. So like labor market trends, this is one of the areas that has been so awesome. We were tracking labor market trends by looking at like the Dow Jones Business and Training is Business Employment and Training Index. We were tracking that. That's been in a downtrend for quite some time, and we were saying, hey, non-farm payrolls are slowing as well, and people thought we were crazy for a year, and we were like, leading indicators are slowing. Now, labor indicators are slowing, and then you get the QCEW report. It comes out 6 months later, and they wipe out 1 million jobs, and you're like, oh. So like the data is kind of messed up when you're looking at coincident and lagging indicators like that or GDP, because when the labor market data is weak, all the GDP data you have essentially, like personal incomes and personal spendings are all overestimated as well. Jobs are overestimated. So they're all estimations. And so our job is just to try to say, hey, leading indicators, what's going on in manufacturing and new orders, and what's going on in housing and building permits and housing starts, what's going on in all this data is slowing. So it's telling us that the data is slowing. And so for that perspective, what we typically do is look at the playbook. We start to look at factors in the equity market or asset classes that would typically perform well. And so one of the things that we saw is when leading indicators started slowing in 2022, which was April, it coincided with the Fed tightening significantly, which is obviously a leading indicator is financial conditions. And then guess what you started to see? You started to see housing struggle. You started to see quality outperform from a factor perspective. High quality and low volatility were the top two factors in 22, 23. And then in 24, It was all about like momentum playing catch up in 24 and 25, but quality was still one of the leaders. So you had this flight to quality in the equity markets in a factor, but because markets went up, people started thinking that the economic indicators were wrong. But in our opinion, they were telling us exactly what should work was working. And so that's kind of the give you a good lens at how we look at economic data as we say, okay, well, what would typically work historically in this environment based on study and testing, et cetera, and what is working? And we saw agreement. So I think the problem with so many people, to your earlier point, we're trying to call a recession. That's done by the National Bureau of Economic Research. It's done after the fact, and then they backdate it. It's completely useless from an investment perspective, in my opinion. So, we'd rather look at the data and just say, what direction is it going?
No, so many good points in there, Clint. Ned Davis, legendary investor and wide following in the institutional community. My favorite quote of his was, "Do you want to be right or do you want to make money?" And it feels like so many investors are kind of chasing the wrong goal, right? You want to be proven right. And I think it is. I think it's an ego play to kind of nurture our fragile ego that we got the call right. And again, my experience working at money managers, one of the worst things you could do is get the call right, but not get paid for it, right? Have the wrong portfolio that wasn't actually doing it. So it's like that had to be your priority. It's so interesting. You shared some really good points in there about data, right? And so Ralph Acampora, right, one of the founding members of the CMT Association, would always say you can restate economic data, which we've just recently seen. You can restate financial statements, right? We've seen companies go back and revise what they said, but you can't restate price, right? You can't restate the fact that a buyer and seller came together at a particular moment. So it's interesting when, so that sort of macroeconomic lens that you described, really valuable. I appreciate you talking through the leading economic indicators. How do you reconcile sort of what you also alluded to, which is the fact that generally speaking, prices have been relatively strong, thinking about, market conditions, even with all of that uncertainty and instability maybe under the hood, the S&P is relatively flat. So how do we reconcile conditions where the market trend remains, in decent shape at worst, when some of the economic data looks less supportive here?
Yeah. So, one of the things we did when we went through a historical study on really it was testing leading economic indicators versus various factor regimes, which leading economic indicators are about 2 months lag when you think about the data, but it's probably the best data we have, my opinion, of course, on from the economic perspective, because a lot of the data comes out pretty regularly, at least monthly. Most of these instances, it's not quarterly, it's not subject to heavy revision. So that's why we picked that data set for the earlier argument. Now, one of the biggest problems was this assumption that leading economic indicators and economic data in general have to agree with the market. There has to be confirmation there. Market indices. I'm talking about the market as like the S&P 500 market indice.
Yeah.
It's just not the case, right? The S&P 500 is a trend following index, a relative trend following index, relative momentum index, if you really think about it. And it's going to change over time as composition changes, the companies that make up the most of it change, and sector weightings change. So it's not always going to be in agreement with economic data. And you have to be okay with that. And you have to step back and say, do they have to? And that was kind of our position. We said, no, they don't have to. But what we did find is there was incredible stability with factors. So underlying factors that explain investment returns, things like momentum, quality, small company bias, value, et cetera. All of these things did actually, especially factor rotation, did actually correlate with economic data pretty strongly. So what we typically see is when you get leading economic indicators accelerating, things like high beta, momentum, small caps, value, they tend to do pretty well, historically speaking. When you have data declining, so these leading indicators negative, and we tested it like 3 months rate of change, 6 months rate of change. We've tested moving average crossovers. They all pretty much, it's a pretty robust kind of test because they all kind of look the same. What we find is that high quality, low volatility, these are the type of areas that tend to benefit. And, so it's really about where in the market you want to look at opportunity sets, Not necessarily go ahead and take a blind position. That's where the risk appetite piece comes in. You need price confirmation. You need intermarket relationship agreement. Most importantly, you need price confirmation. So we need price trends to be supportive of the position. But when we look at all that, it's pretty stable historically. It's when you try to get this black and white binary kind of thought process, got to go a level deeper. You can't just say, oh, it's good or bad. I think that perception is very dangerous in investing. Positive or negative, bull or bear, right? That might be okay for getting clicks, but it's not okay for making investments. Yeah.
There's a huge gap often between the language and energy we would use to gain clicks versus what actually helps you manage a portfolio. And I appreciate you, explaining that difference. 100% agreed. You'd mentioned a number of times intermarket analysis, right? Cross correlations, this relationship between different asset classes. And we've, certainly seen in the last 12 months, at least, times where non-equity asset classes, non-US equities, right? Other areas besides just kind of the S&P are outperforming and doing quite well. When you're thinking about asset allocation, is it more just analyzing each of those markets separately? Is there some sort of some sort of relative strength work there, or ratio analysis that you use to sort of compare opportunities, and what does that look like for you?
Yeah, our risk. So we have like a risk composite we look at, and risk composite is price, which is essentially 2/3 of the composite if you think about it from a weighting perspective. And we're looking at prices individually, so absolute price trends across asset classes. So we're not comparing them relative at this point. So what we're doing is we're saying, hey, what's going on in crypto markets? So Bitcoin's incorporated in that. Why? Because we think, based on our study, Bitcoin in its, obviously it's still an infant asset class, but crypto in general does have a correlation with risk sentiment, does have a correlation with liquidity trends. It does have a correlation with things like the NASDAQ. So we look at it. It's in our toolkit. So we look at price trends in Bitcoin and crypto. We look at price trends in high yield bonds. That's been one of our favorite areas in terms of system design. In particular, when we're trying to identify regime change, is paying attention to what's going on in credit markets. So we pay attention to high yield credit. We believe very strongly in kind of this philosophy of if you get the credit market right, you get the market right? You get the economic situation right because we flow on credit. So we pay attention to high yield. We pay attention to global stocks. And that's everything, emerging markets, country specific. We look at US domestic. We look at styles. We look at factors. We're looking at price trends and breadth. We're looking at sectors. We're looking at anything and everything we can in these markets to determine are they in positive trends or negative. So that's like our absolute price trend series. Then we look at intermarket relationships, which is super important. And those are things we're looking at: high beta versus low vol. We're looking at small caps versus large caps, looking at value versus growth. We're looking at equal weight versus market cap weight. We're looking at domestic versus international, developed versus international emerging. We're looking at domestic versus international. We're looking at micro caps versus the market, banks, financials versus the market, utilities versus the market, sectors versus each other, discretionary versus staples. All of these things have a ton of information in it. And we look at them and we do summation indices, and we're just trying to determine, hey, are more cyclical sectors in favor, more defensive sectors, or cyclical factors? What areas are getting positive benefit? We look at commodities versus each other. We look at copper versus gold, lumber versus gold, base metals versus precious metals. We look at agriculture versus others. There's a lot to look at, a lot of information. And you can't just rely on any one subset. For instance, gold with its rip recently, at the end of the day, if you would have said, oh, this isn't bullish because copper versus gold's at new lows, or lumber versus gold's at new lows, you get too isolated on two things, or stocks versus gold, or stocks versus, or gold versus bonds, or whatever. You end up getting kind of lost in one thing. So we measure everything against everything. And we just as Dorsey Wright used to say, who's another famous technician, he say, I'll arm wrestle all these things together, right? Using point and figure charts, and we see who's winning. And we do the same thing. So I borrowed that completely from him and Murphy and all the great intermarket technicians who have just helped me with that. I see a lot of information there, especially as it relates to regime change. So we pay attention to that. And then lastly, we look at breadth. We look at bullish percent charts primarily. percentage of stocks above 150-day moving averages. We don't use 200-day because everybody does, and we want to be different. There's that ego again. But yeah, so we look at, percentage of stocks above 150-day moving averages and all the major indices. I track all the Dow stocks and look at the percentage of those in positive trends, percentage of those hitting all-time highs, track all these country ETFs, what percentage are hitting all-time highs, what percentage are in positive trends. A ton of information to gather using price, and it's awesome. So that's what helps us kind of keep our risk composite on the right side typically, because it's just measuring what's going on.
Oh, so many great points in there, Clint, to be honest with you. And what's refreshing to me is, as you were listing out all of these things, you were implying there's a structure there. It's not haphazard. It's not, well, maybe sometime I'll look at this ratio over here. I'm assuming you have some sort of regular process of kind of going through and evaluating information. Can you share, what does that look like for you? I mean, is there a routine? Is there a time during the day, during the week, during the month where it's like, and then I need to update all of these models? Or what does that regular process look like? Because I know that's what a lot of viewers struggle with, is the consistency and the routines, right?
Yeah, I've had the same process for forever. So every week I write a Monday. So part of this is I always do the content, and I never let any team member do our content. They can draft their own content and publish it in our white papers. We always feature it in annual reports, but that's up to them. The important part of my process is I write every single day on markets, and I write every single week on markets. And most of my work's done on the weekend. So what I do is I do most of my like intermarket charts, most of my price charts, most of our systems are built on either weekly or monthly data, because we're trying to influence asset allocation decisions, not necessarily trading decisions. Although the daily information I do track as well, and I review it. I just kind of review charts every morning on the daily side, just because I like to stay up to speed with market as part of my process, but I don't really incorporate that into commentary. The weekly piece is my favorite. So Saturdays, I gather all the data and I have a handwritten notebook, and I literally write every single asset class, what led, what trailed. I do intermarket relationships, and I track everything from FIC markets, so fixed income, and I add another C, so fixed income, currencies, commodities, and crypto. I track everything in the equities market, track countries, sectors, primarily equal weight sectors, styles, factors, measure it all, map it all. I keep a scorecard of essentially what's in a positive trend, what's in a negative trend, short, medium, and long. I look at relative trends, short, medium, and long. I keep notes for what happened last week. I look for outliers, because I think outliers tell a lot of stories. Like recent breakouts in metals and mining, we started featuring last October. That was an outlier. Something was happening underneath the hood. I was like, there's a rotation going on in the real assets. Like, this is something we need to pay attention to. And then you started getting confirmation data to that. And that was exciting. So my weekly process is all about recording all that information on Saturday. And then Sunday after church, I write. Usually that evening, I'll draft a weekly market commentary and grip summary. And then I put together a slide deck that we go over with our advisors every Monday morning at 9 a.m. And so we kick off the week with what I call the weekly macro call. But that process I have done for forever. And that's really important. And then monthly, I do a monthly trend report. That's also my favorite time. And actually, JC is who I kind of borrowed this from. He's always saying, "Oh, I look forward to monthly charts." And I was that's a really great thing to do, is to step back and just take a big picture view of what's really going on, what's hitting new monthly highs, because the daily and the weekly can sometimes be a lot of noise. And our job is to, essentially figure out what's the signal versus what's the noise. And monthly charts are great at that. And so I do a monthly trend report where I feature a lot of that. And I track everything, economic data, I'll do monthly charts on. That's great. Do economic, obviously market data, where I track all these intermarket relationships or typical risk composite stuff. And just try to, I just love it. So I just try to, go through as much as I can and then report on it.
It's so funny, Clint. You'd mentioned, JC Peretz does a great job with monthly candles and monthly charts. 100% agreed. And I love how you described your process, the weekly, the monthly. I found very few technical analysts or technical analysis driven investors who don't deeply enjoy the process of analyzing charts and sort of working with them. And I think that's maybe one of the threads that kind of connects us all. I'm curious, when you think about how you're, the takeaways to your process here most recently, right? When you're doing your most recent weekly review, And when you're thinking about the advisors that you work with, and I know, again, a number of people watching and listening are in the advisor community, um, how should we be thinking about technical analysis, and particularly this idea of momentum and trend? How does that translate to building relationships or nurturing relationships with customers? Because what you talked about, you outlined a number of things, and there are a number of very specific technical approaches and ideas, and translating that into making someone feel better about what's happening in the markets. There's a process there. So how should advisors be using this sort of toolkit to nurture a relationship with client?
Yeah. So, I view my job as it's from I think Einstein said it, but make things as simple as possible, just not simpler. Um, you know what our job is as technicians is to take all this information, and you got to love the process and love the journey. And I remember your talk at the CMT, your keynote on the process, right?
Mm.
You brought in your pilot training. That is exactly, you got to love it. You've got to learn to love. It was the old Steve Jobs quote, right? Do what you love. In my opinion, it's just love what you do. Figure out how to love what you do and love the process, because you've got to go through a lot of information, take a lot of time. And then what you've got to do is try to sum that up in a simple format to gain credibility and confidence. If it's too complicated, clients aren't, it just go over their head, or they'll tune out, and you lose credibility and confidence if you can't communicate something simply. I go back to our college math class. What was math all about? Math was always taking the complex and making simple. Everything is all about that. I think we have to take that same approach as technicians, and advisors have to take that approach. They have to say, what's the most important signal in this data that I can relate to a client as it applies to them, what they're worried about, and the questions they have. So that's what I always advise our partner firms on is, hey, find out what the client's worried about. Ask them, let them tell you what's on their mind. Typically it's something in the news. Oh, the S&P went down, or, software stocks are getting crushed or whatever. And you can say, hey, we are seeing software stocks get crushed, but this is one of the things we saw months ago. We saw software falling against hardware. We saw AI being more of a real asset trade and a hardware trade than a software trade. We started seeing these signs within the market, and this is why we apply this framework. And so you can kind of point back, and that's why I think it's really important if you're going to be a market strategist to write, because you can always point back. And this is a two-edged sword, but you can always point back to your wins, your losses, your pros, your cons, the mistakes you've made, the positive things you've done. And that does nothing but establish credibility within clients. And so I always say with our advisors, simplify, understand where they're coming from, what's on their mind, because it's always a worry that matters to them. Don't just show up and throw up data, and then try to pull from your bag of tools, the things that you've researched, things that you know. And if you love the stuff, you know it innately, you can tell someone I bet I could ask you any day of the week what's going on in markets, and you could tell me sectors that are starting to rise. You could start to tell me about breakouts, right? It's just, if you're in it, you're in it. And so get to that point where you can communicate to them based on their needs, and then simplify it for them. And if you can do that, it establishes credibility. And that's why we built the framework, so that our advisors had a framework for communication. Not necessarily, there's application to it, right? We have to be able to apply it, but it's really a communication tool more than anything.
Really well said, Clint. So many ways, and I hope the advisors listening take that to heart, because I think that's well said. And the most important thing I think that you mentioned from what I heard was understanding and asking the right questions to establish what they're concerned about, right? And then figuring out how you can use the tools and techniques that we have available to help them address those and alleviate those. I think that's very well said. Just to finish off here, Clint, I mean, you've got a pretty thorough process that you outlined for us. It sounds like you're looking at a decent number of charts every week to try to make sense of things. And I would wholeheartedly agree. I always tell people, if you're trying to learn this stuff, start a blog that you never share with anyone else, just for yourself, just to get in the habit of doing that. Because for me, writing, doing videos is where you really have to be able to understand it very deeply. But with all that you're looking at recently, what's sort of that most important risk that stands out to you? And maybe what chart or what indicator do you think is most important to follow? Because you've touched on a number of things that could happen. What stands out to you as you're evaluating conditions here late February 2026?
Yeah, one of our kind of big notions, and if anyone follows me on LinkedIn, you'll see it. I think most of what we're seeing now is rotation, and I think that's healthy. But I think there's a lot of people, and I think the but's important. But there are a lot of people long kind of the S&P, and that's all they really look at. That's all they really focus on. The Mag 7, there's a lot of exposure there. And I think that has a lot of risk to it. And so a lot of times when we see like these things that start as rotations, which look healthy underneath the hood, you're seeing materials materials have been ripping all year, really starting to lead now on a year-over-year basis in the top 5 sectors. You're seeing energy breakout of huge multi-year bases, relative and absolute trends. You're seeing value rally against growth and move to positive trends on short, medium, long. You're seeing small caps, micro caps, small cap value, mid cap value. I mean, you are seeing a massive move in regime change that can get chaotic when you're talking about the most heavily owned stuff being what's sold and rotated out of. And I think that's the biggest risk. You have a lot of concentration. There's nothing wrong with concentration on the surface. Actually, it's more of a feature of markets than anything else. But when you get the rotation like this, if it ends up being a chaotic rotation, you can kind of get those, correlations go to one type events. And I think that's the big risk. So paying attention to risk, what we look at is like regime risk. We'll look at credit spreads. We'll look at a lot of these relative relationships, seeing and when things really start to move risk off, low vol versus high beta, treasuries versus any other bond asset class, or treasuries versus stocks. Look at the number of countries breaking out to the upside or in positive trends. We're not seeing any of that breakdown yet. So right now, most of the countries we track I think we track 40 countries. I think 23 were at all-time highs last week, or 22 were at all-time highs. Most of them in positive trends. I think only 4 in negative trends. We're looking at most of the factors we track are at all-time highs. Sectors breaking out to all-time highs like energy and materials and industrials. All of these things are not telling me that it's a risk-off move yet. High-yield spread still relatively, low when you look at it relative to history. Still below 10-month moving average. You're seeing, maybe a little spike, but nothing to say, oh, we're in a clear positive trend on spreads, meaning they're widening and risk is widening. But you're seeing pockets of risk, seeing business development corps break down against, treasuries on a relative basis. You're seeing, listed private equity companies in negative trends. You're seeing the Mag 7 become the Lag 7. So you're seeing things that are like, oh, there's some risk there, but I'm not seeing anything that says this is a quote unquote risk off move yet. But those things can happen and can develop. And so I think you just got to always keep an eye on risk management. It's important.
It's so fascinating, Clint. We're going from a year where not owning the Magnificent Seven was a disaster for your portfolio to now owning the Magnificent Seven is a disaster. I mean, it's tough to keep up. But I think to wrap up our discussion, I think your comments about the consistency with which you're evaluating information. For me, it's not about having the perfect crystal ball that you just need to make sure is shiny enough. It's just having a consistent process. It's showing up every week, every day, whatever that is. And that's all you need to do to recognize shifts. It's keeping your eyes and ears open. So I hope everyone watching and listening gets some ideas of how they can do that in their own process. Clint, this was awesome. As always, good to see you again. And thanks for your insights and explanations. Where can we point people to learn more about what you're doing at Ascentis?
Yeah, follow me on LinkedIn. I started ramping up stuff there. I got off X just because I was doom scrolling. So I had to.
You seem happier, Clint.
Mental health. I'm telling you, I'm a lot happier. I told my wife one of the best things I did to make my life better was, and this is not a knock at X. I think X is a fantastic platform, but and I still use it. I just use it on TweetDeck instead of going in there and doom scrolling. But I post more on LinkedIn. So follow me there. And then, AscentisAsset.com. You can track me there. We have a site, a gated site, but anyone can get access to it if you just send a request. You can get our research. We give all that away, not because we don't think it's valuable, but because that tends to lead to relationships for us. So we're prolific in terms of content production, and we're happy to ever have a call or share anything with anyone where we think it's an open book, and we want everybody to succeed. And the more wealth that rises, the better for everybody. So we're for prosperity for everybody here. And then I want to thank you, Dave, for all that you do, not only for the technical analysis community, but for the community at large. You got a big voice. You're an expert. It's always a pleasure to see your content. Learned a ton from you. So I just appreciate what you're doing for the industry and for technicians everywhere.
No, I appreciate it, Clint. And listen, I hope people can check out your content on LinkedIn, on your website. I mean, great process, and congrats to you on your successes. I hope we can continue the conversation again soon. But for now, I'll say thanks again for coming on.
Yeah, absolutely. Thanks, Dave.
Hope you enjoyed that interview with Clint Sorenson. Again, thanks to Clint and the team at Ascentis for making the interview happen today. Clint's awesome. I mean, what a genuinely nice guy and a thoughtful and knowledgeable market practitioner. Sort of a great combo of all of the above. Really appreciate that GRIP framework, and again, whether or not that is similar to your own framework. One of my big takeaways with the conversation with Clint. Have a framework, right? When I asked Clint, how do you think about technical analysis in your process? He laid out, well, here's how I approach the markets. It's this framework. Here's the G, here's the R, here's the I, here's the P. And I like those as 4 different pillars. Sort of my pillars are a little bit different, but I have a structure too. And I think that as one key takeaway is be able to clearly articulate your structure. And there's a number of ways you can do that. If you're an individual investor, if you're an advisor, I always talk about doing like the one pager, right? The sort of portfolio statement or your purpose for being as a money manager. This is an exercise we would do with portfolio managers in my previous roles, where you would have to, on one page, articulate your process. How are you going to generate ideas? How are you going to think about positioning? How are you going to think about risk management? What's your team look like? What resources and tools you're going to use? What are your processes? What are your routines? And so, by laying those out, just the process of creating that one-page sort of, portfolio statement really helps you identify weaknesses, right? And before the final version is done, that rough draft, you'll immediately recognize things that probably could improve in your own process. So that was one key takeaway. Another one was just the process with which Clint is going about, evaluating market conditions. He and I, and this is something I picked up very quickly on from the panel that we were on together in Tampa, is that we have very similar ways of thinking about it, right? The weekly process being most important. Ideally, you do that when the markets are closed, when things are quiet, and you can pop on some music and just really dig deep into what's happening. And that's sort of the most important time, I would argue, that I spend every week as an investor. Then I take that process and I turn that into a weekly report that I send out to my own clients, right? And so it's not just the steps that you go through, it's the end result, which is boiling all of that work down into a concise set of evaluations and an investment thesis that you can share with someone else. Then there's the monthly process where you take a big step back and a big deep breath and you evaluate what's going on, on longer term timeframes, which I think is beautifully put. Then in the daily, I think if you heard Clint mention, it's more reviewing, right? It's more updating what's happening day to day. And that we have very similar ways of thinking about those different timeframes and how important they are. And the weekly one is the most important. So, my question to all of you, what's your process look like? And if you can't answer that, if I'm interviewing you today and you can't answer the question as well as Clint did in terms of here's what I do every week, here's what I do every month, here's what I do every day, here's why, I find just the process of explaining that to someone else, you immediately find if there's one of those areas where you're a little weaker, right, where you could stand to improve a bit. Really appreciate Clint's thoughts on the overall market conditions, and I would tend to agree. We're undoubtedly in a rotational period, in a transitional period. I would argue the outcome, right, the end result of that transitional period at this point is not 100% clear. I could see a scenario where the markets recover quite well from here, and the strength that you're seeing in a lot of the cyclical sectors could be enough to push things higher. If the Magnificent Seven start to improve a bit, we'll find out, in the days and weeks to come. But I could also see a pretty ugly scenario evolving as valuations, which investors have woken up to, maybe combined with some concerning data or earnings misses, could cause the market to go lower very, very quickly. But given all of the moving parts underneath the hood, the S&P for now remains sideways. So I think that in our discussion here today, I hope you appreciate Clint's summary of all of that sort of conflicting data right about now, and some of the tools and techniques we can look for signs of what may come next. So thanks again to Clint Sorenson of Ascentis Asset Management joining us on the show today. By the way, if you need help upgrading your own routines, if you are trying to figure out what to do every week, every month, every day as an investor, and you need someone who's done it for a while to help you, our Market Misbehavior premium memberships could be a great opportunity for you to upgrade your investment process in 2026. 3 great benefits to the premium membership. First off, virtual courses where we teach about behavioral finance, technical analysis, and some of the tools and techniques that I've learned can help me better understand market conditions and improve my market awareness. Second, I've got reports that go out to members only, like my weekly flight plan, monthly chart review, and so forth. Finally, you'll have full and immediate access to our member community where you can ask questions, where you can learn from other like-minded investors, just get some good ideas through the course of the week. You can find more information at marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today's episode of the Market Misbehavior Podcast. Thanks so much for joining me here today. And remember, it's always a good time to own good charts. Take care, folks.